what does a company need to meet for it to actually be considered in the fund?
As I say, we are sort of style flexible. So we've got good, what we consider good quality value stocks, like traditional value stocks, cyclical. Often it's a cyclical type play. And then we've also got companies that are higher multiple, but good quality companies where really the investment thesis might be centered on just the duration of growth or the sort of how long they can sustain high returns on capital, more of a traditional quality growth type of investment. So we will consider ideas that have varying metrics and characteristics. You know, I think at the end of the day, there is a desire to have companies that we consider good quality. And so what does that mean? That means that the company usually will have good economics for starters. It'll have a balance sheet that's appropriately levered. We don't screen out high leverage because sometimes that high leverage is perfectly appropriate for the nature of the cash flows that the company generates. And it'll have a management team that's executing on a strategy that we can get behind. So it's, as best we can from the outside, a capable management team, if we can, as best as we can evaluate that team. You know, we want to be aligned with management that's executing on a sensible strategy. Typically, those companies will be in growing end markets. They will, like the exceptions would be where it is more of a cyclical type story, where you're really just extrapolating the low point in the cycle. Maybe there's not as much sort of through cycle growth. They might be a bit more mature. But the core of the portfolio really will be companies in growing end markets where they've got strong market positions. They'll be at least sustaining, if not growing, their market share. I guess the final piece, like this is a lot of the sort of characteristics of the company. The final piece would then come down to the stock. And here we'd be looking for where we can see upside to estimates, or at least, no downside to estimates. We're expecting the company to be able to deliver on market expectations or surprise positively. And then secondly, that they're at a multiple which we believe's, like for our really high conviction positions, a multiple that is well underpinned. And perhaps when we look across the market at peers, or we look at the growth that they have, has decent scope for upside. But importantly, the investment thesis isn't centered around that re-rating. It'll be like we're looking at companies that are generating enough earnings growth for us to make a good return out of the investment, even if the earnings multiple doesn't change. But if we can find a stock that meets that criteria and has significant upside to the multiple as it sort of executes on what we believe it will execute on, then that could be a pretty compelling setup because you get that blue sky re-rating potential as well.
You make the criteria sound so simple.
Yes.
It's in the doing, I guess, that's the hard part. One element of that I want to follow up on is the assessing management, because you said, as best you can from the outside. And I guess that's the challenge being a global fund manager based in New Zealand and Australia. It's that getting FaceTime with some of these, global CEOs is harder. Yeah.
That's a challenge.
Yeah. So what are some of the things you look to? Because this is a challenge for advisors and for retail investors, for everyone in Australia really looking at stocks globally. So what are some of the metrics or criteria or factors that you're looking at when you're considering a management team from across the other side of the world?
Yeah, no, it's. There's certainly some value, I think, in being in the room with management. It helps you get a better feel for what's sort of motivating them and some of the nuance around how they're executing, what they're trying to drive culturally, that sort of thing. Despite being on this side of the world, we do get those opportunities. Maybe not with the really, really large mega cap companies, but there's a heck of a large universe that's smaller. And when we I was going to say when we travel, but it's not only when we travel. So when we travel, I've got great experiences where you go down to Cleveland or somewhere like that, and you get 2-3 hours with the company, including an hour with the CEO, and then you get to tour and meet some people in R&D and sales. Like you get really, really good access. But even from Australia and New Zealand, we've got reasonable overlap in terms of time zone, and so we can make calls with the US at in the morning year round.
Just not Europe.
Europe's harder. It means after dinner calls and that sort of thing. Yeah. So it's not impossible, but it does interrupt family life or whatever else a little bit more. But I guess building that relationship usually initially with investor relations, but then over time, once you've built that relationship, we've got lots of examples of where you then get a virtual, especially these days after the pandemic, you get virtual access to CEO, CFO, anyone else in the organisation that the company's sort of open to. So the access is there. I think the other thing that we look for is just what are they doing? Like looking at what strategy they are executing on. Are they doing what they say they do? Do we think the strategy makes sense? To help us evaluate that, and also some of the cultural sort of elements of that strategy. We do utilise pretty heavily expert networks. And so, we're able to speak to formers from the company or other people that are, perhaps working at competitors or customers or suppliers to get a better understanding of one, the industry, but two, of exactly what that company is doing. And, that for us has been an important step in evaluating some ideas, particularly where, perhaps the company makes a lot of acquisitions. And so being able to speak to formers from some of the acquired companies to understand what do they really do when they after they've acquired that company, is a sort of an important step in the process. So, I think sometimes being in the same room and being able to look management in the eye is perhaps a little overplayed in terms of the sort of value in that. And I think we've got both enough the access that we need, and then there are enough other sources of information that go into that kind of assessment to get a reasonable evaluation. Where we don't have a reasonable evaluation, we'll manage the position size. So it might be that we'll own a company in smaller size until we've been able to flesh out the succession plan, or until we've been able to flesh out that post-acquisition integration, whatever it might be. And then as we build conviction, we can scale that position up over time. So API Group, I think this is a really good example of what we've been talking about. API Group effectively is an industrial services firm that will install, inspect, and maintain life safety and security systems. So if we look around the room in here, you've got the smoke detectors and the sprinklers and the fire alarms, that sort of thing. They do it also in security, so looking at security systems, and then they've just recently acquired a business on the elevator service side as well. The interesting thing about all three of those businesses is that they're fairly resilient as well to the macro. And so when it comes to, if we take the fire and safety piece, because that's the lion's share of the business, it's mandated either by regulation or by the insurance companies that might be insuring the building that those systems are inspected, at least on an annual basis, sometimes even more frequently than that. How many widgets your customer's selling, or how profitable those widgets might be at this point in time, they still need to have those systems inspected. So API will go in, it'll fill out an inspection report, list some defects, and then it'll pull through service and maintenance work on the back of that defect list. And that defect list has to be addressed in order for the building to remain compliant. And so for every $1 of inspection revenue that they generate, they pull through $3 to $4 of sort of maintenance work afterwards. So it's a very fragmented industry. API is the number one player globally. They've got about a 10% market share. Wow. There are thousands of other smaller operators there that typically tend to focus more on the installation work because it's bigger ticket. Like an inspection and maintenance order might only be a couple of $1,000s, whereas an installation project could range, up to $1 million perhaps. And so, if we think about the customer behaviour, that installation work is much more competitive because you go out to tender, you get a few different players in. When it comes to getting your facilities inspected, often it's just the one player, and they've got it almost becomes a recurring revenue type stream. And so API, unlike the rest of the industry, is really focused on inspection first rather than the project piece. And so for us is quite compelling because it's much more resilient to the macro. They're able to by sort of focusing on the incumbent buildings that are out there, the installed base of buildings, they can have a direct sales force that's kind of driving in to win that inspection work rather than spending time tendering and sort of looking at new bids on new construction projects. And
so when you go back to your investment process, you think about like the qualitative, quantitative overlays and the macro. What's the investment thesis behind it?
So the investment thesis is effectively that you've got a company that's somewhat independent of the macro and somewhat independent of the political landscape. So that was an important consideration for us as we moved through last year when when we were approaching the elections and we weren't sure what the outcome was going to be. We were trying to find companies that we believe would be sort of fine, regardless of who ended up sitting in the White House.
They don't agree on much, but they agree on fire safety.
For now.
For now.
For now they do, yeah. It hasn't been such a hot topic.
Yeah.
They are looking at generating, in our view, mid-teens or above type earnings growth, and we think that earnings growth has a long duration. There's a long period of time where they're going to be able to generate that type of EPS growth, and the stock's trading on around 19 times earnings. It was a little bit cheaper than that when we bought it, but 19 times earnings for a business that we think for several years can generate sort of 15% plus EPS growth is pretty compelling. If it delivers that 15% EPS growth and the multiple stays at 19 times, then in 5 years' time we will have doubled our money. Mm-hmm. If we look across at sort of high quality or reasonable quality industrial service peers and some other sort of industrial aggregators out there. So you've got companies like Cintas and Rollins, Core and Main, Graco, IDEX, the whole waste management space, even Ecolab. I wouldn't necessarily put it from a quality standpoint quite as high as those businesses just yet. I think it can improve and get there, but it's growing faster. It's got very dominant market position. It's got a long runway for growth, and could this trade a few turns or several turns higher? Quite possibly. I mean, all those companies I just listed trade between 24 and 45 times earnings. So there's a lot of blue sky potential, I suppose, to that multiple that could come through as the business wins over investors. So it's only been listed 5 or 6 years, and it's only a 10 billion, 11 billion market cap.
Yeah, right.
Just quickly on the downside, what are the risks, or most importantly, what's the thing you're watching that would break your thesis?
Yeah, I think the operational risk is reasonably low on this one, partly because of how resilient it is, partly because the management there has been in place for 20 years executing on a very consistent strategy. So I think that the main risks would be part of that earnings growth algorithm is M&A, and so it acquires other players in the industry, which is what really, because it is so fragmented, gives it that long duration growth. There is always execution risk around a large deal. They have made some large deals in the last couple of years, but the results there have been really impressive. So I don't think that's a risk today, but should they announce another large deal that they don't execute on properly, then that would obviously impact confidence. And then I think the other risk from an execution standpoint would be more around management and succession. So the CEO has been in the seat for 20 years. He's not going anywhere yet. There we've sort of built confidence through what we've learnt from the company directly and also from the expert networks in terms of the way that they are training leaders right across the organisation. So it's a really interesting and valuable aspect of the corporate culture. And so I guess this is one company where initially we were smaller while we built our understanding of that, but we're sort of fairly comfortable to be able to manage that risk. But I think it's a key person risk and execution around large deals would be the main ones.